Hi, it's Dr. Ron here with some tips on the LiquiSolvent Strategy tool because this is such a critical tool to help you help a company find a sustainable strategy for which they've got the abundant cash. And let's just assume right from the beginning that your company wants to grow. And if you've had a strategy class or an entrepreneurship class, people come up with all sorts of ideas, but then when they come to find abundant cash, they don't have the cash to get their ideas to work. So what we're doing in this tool is looking at their financials and saying, here is a realistic picture of where you are and what would be a likely budget. And of course, you may have other factors at that point as the client. You're talking to the CEO team and they say, no, we've got our own plans, and they argue with you, and it turns out they've got some good reasons. But this at least gives you some key questions that you can ask that put them in the right mood to develop a strategy and abundant cash together. Let's start with the fifth page of the tool, the environment. Of course, you're an accountant. You're not in the business of doing coffee like Starbucks or selling cars or anything else, but it still is good to have Govindarjan's 5-week signals. Doesn't take you long to find the information for the company you're studying in the industry. And it gives you a feeling for the business environment that you are asking these questions in. So in the case of Starbucks, I looked at government regulations. I found out immediately that brown coffee, it's a Cambodian company, so it does not import a lot of stuff. It imports the coffee, but a lot of the other stuff, it's purchased or done right here in Cambodia. So there's no import duties. There's nothing of that. There's no transportation costs. Whereas Starbucks, by the very nature of the company, it imports a ton of stuff, and because it's a foreign company, it is seeing some import duties as well. So brown coffee has a competitive advantage. It doesn't mean that Starbucks' job is impossible, but it does give us a question to ask. How are you going to surmount that? And then, of course, the actions of competitors. Brown Coffee and Starbucks both want 100 stores in Cambodia. They both have about 50. So just knowing that there's another powerful competitor, again, this is information that we keep in our minds as we are looking through all the other parts of this document. Now we know what this is about. We're trying to help Starbucks figure out what kind of budget for next year will allow them to continue growth. So we're looking to see what kind of cash do they have, what are their prospects, and we'll start with profitability. And if you go over to that page, I'm going to start at the bottom. And some of the stuff is okay, so I'm not going to say anything about it. But I do want to look at the interest coverage. That's on line 99 of my template. And interest coverage is very important to the banks. If, let's say I buy a condominium in Phnom Penh, it costs $200,000, and I borrow the whole amount from the bank. Not realistic, but let's go with it. So the bank, let's say they are going to get 5% interest, so they want $10,000 per year in interest. The bank does not want the $200,000 back. They're going to get that back slowly. What they really want is that $10,000 interest. And if you can't pay that, they're watching it and they're going to come down on you. It'll be a disaster. And so as we look at Starbucks, of course, they can, good grief, they've got 11 times, 12 times, 13 times their interest in cash. So they can easily pay their interest. Anything over 1 is okay. It means you can pay the interest. But if you look at the trend, they keep losing 1 per year. And now they're down to 11.77. Do that 10 more times, and they have no cash. So there's a question for me for the Starbucks company is a question about where are we going with this trend? What does it mean? What have you discussed? And what results do you hope for in the future? And then the other thing I want to look at is overhead growth versus revenue growth, lines 89 and 93. So the revenue growth in the most recent year grew 201 from the previous year. So it grew. This is good. But if you look at overhead growth in the same period, that grew by 846. So their overhead is galloping away with them. Again, another rich question. How, when is this going to come into better sync so that you don't have revenue growing so much less than a key component of the income statement, which is operations. And then when we go up farther on the income statement, we see really what is carrying this whole thing is the gross margin. So are they making a profit? They sure are. And they've improved the profit. If you look at the gross margin from 10 years ago, 59% to now 69%, they've improved the gross margin. They make coffee more cheaply. They distribute it more efficiently. Who knows what goes on in all of that? But they really are improving the gross margin significantly. What they are not doing, if you look at operations, it was 23%. Now it's down to 18%. And net profit was 14%. Now it's down to 10%. So what you're seeing here is that it's more expensive. They're not seeing the same progress in cash or in net income from operations or net profit. And they're stuck. One of my research questions then would be, can you push the gross margin any further? I mean, one of the things is they've got it to 69%. Maybe they could get it to 73%. But I also think probably there's a question there when you go back to overhead, it is growing too quickly. And no matter what the gross margin is, here is a question to ask. We've taken the profit in this page and split it up into the three components. Is it because of, well, four really, because of revenue, because of profit from direct produced inventory and all of that kind of thing, making the product? Is it from operations itself, or is it from net income of the whole company, including whatever they're doing with financial investing? So we got some rich questions from that first page, at least three. And you might have seen four. I'm just giving you my perspective. On the trade capital page, they are killing it. So there's really no questions here. Trade capital this is almost a picture-perfect model of a business. So what Starbucks knows how to do is control their inventory, their days of accounts receivable, and their days of accounts payable. So I didn't see any research questions coming out of that. I admired it, but it wasn't a research question. And then I went over into the other financials, and there was something troubling there. And that is that if you look at the return on total capital employed, it was 31% 10 years ago, and it's dropped down to 16%. Well, what is total capital employed? It is all the assets minus current liabilities. Now, why would you take away current liabilities? Because you're going to pay those bills pretty quickly, so you certainly are not going to make a profit from them. So you have to take those away from the total assets, everything else remaining, whether it's cash, fixed assets, anything else, just that total assets column minus the current liabilities, and then you divide the net income by that total. And 10 years ago, they were making a significant profit on their cash. They were using their assets. They were using their assets extremely well. Wow. And then you see that 3 years ago, it had gone down to 18%. So a big drop, but then it doesn't stop. Go down to the latest period and it's 17%. Now, this is partially just because they're a huge company. They've got 40,000 stores, and at some point, there is no longer scalability in terms of economy. So they probably have hit that plateau, but what they cannot afford to do is to let this thing, the total capital, return on total capital employed, they just can't let it keep going down. So there is a rich research question for the C-suite right there. That was the thing that I really saw in that one. And then we go over to the integrated, putting the whole thing together. And some of the top numbers look pretty decent because the liquidity with the cash flow conversion is incredible. The profit is in there. You notice I had two numbers there. I had profit and I had cash flow from operations. I took the smaller one of the two, which in this case was profit, and that was just to be conservative. I could have put the cash flow from operations in there, and so I came up with a total liquidity capital of 26.798. Incredible. And then solvency, because that's liquidity, but it's not including the total depreciation. They're going to have to buy more machines at some point. And it's not including the 2 months of buffers in case like if COVID closed down the world again or something like that. So I called that at-risk capital. And it's not something to deal with. It's just as you're creating the data, you're developing your own opinion as to the rate of growth that this company can afford. So we add that to our thinking. And then finally, we come to the strategy. What's our future capital situation going to look like? Well, it turns out that Starbucks is making a profit of about 6% per year. I got to that because I subtracted from their 8 or 9% profit, I subtracted the inflation over those 10 years. And so they're doing fine. On the other hand, when they look for new investments, they should either match or even beat that 6%. So that gives them a guide as to what kinds of investments might not be wise and what kinds of investments they should seize. And then I also looked at their leverage because usually companies can borrow some money in addition to what they have on hand. And how do we calculate that? Well, here is a rough formula. EBITDA, you've heard that before, earnings before interest, taxes, depreciation, and amortization. And that is just something we can get off the balance sheet. We just look down there. It's basically the net income from operations. So don't just ignore the net income from non-operating expenses. So what is the formula? Quickly, a lot of companies, you can tell what they are worth by multiplying that EBITDA by some number. Now, 4 is unusually low, but 4 is really where some service industries would be because there's not a lot of assets. And one of the people that I was actually coaching wanted to sell the company and buy another one or start another one. And so I said, well, yeah, your profit is $50,000 EBITDA. So I guess you could probably, in this situation, you could get about $200,000, and you probably have to agree to stay on 1 extra year to lead the company while the new owner got used to it. And they felt like, I've done all this work. I've got a $3 million budget, and I only get $200,000 out of this thing. Well, yeah, that's the way valuation works. And then on the other hand, you can get, if it's a phenomenal company, you might be able to get 15 times EBITDA. With Starbucks, I put it in the middle at 10 times EBITDA. So you see there is the 6.6. And then a bank is not going to loan you the full EBITDA. I mean, they're willing to listen to your argument for what you think the company is really worth, but they're going to take some percentage of that. I said 50% with Starbucks because Starbucks has a good brand. It's got a good track record of financial discipline. So to me, 10 times EBITDA sound reasonable. And then 50% of that would be the loan maximum. So that gave them a tremendous loan maximum of 50% of EBITDA. But they've got a problem. I looked at their long-term liabilities on the balance sheet to subtract that because the bank, if you're fully borrowed, the bank is not going to say, well, forget that, we'll just add 50% more. Starbucks has a tremendous long-term liability. They almost have, out of the 3.3 that's I considered available, 2.9 of it they've already borrowed. So they're not going to get much money from leverage because they've already had that party. So you see, you put all those things together, and then you come down here to the 3 budget scenarios. And now this is where we really talk with the client, or you talk with your boss and offer alternatives. And I have three alternatives standard. One is you got deficits, you got problems, 10% decline. Cut expenses by 10. The middle one is the safe route. Grow a little bit to match inflation. So in other words, this is not a year to grow. This is a year to trim the sails, get things working a little bit better, and then just match inflation. Or the third option is do a scaling increase, which is 20%. That's the definition of scaling, is 20% growth in revenue. And I could see Starbucks saying we got to do that because in many of the remaining places in Cambodia, they want to do 50 more stores. They're not going to do them in Phnom Penh, but let's say they do it in Port or Sisapan or Bavet, Karachi. These places could take one store, but can they take Browns and Starbucks? There is some advantage to being a first mover, and maybe they think they want to roll the dice and get in as quickly as they can, and they're going to move heaven and earth to do that 20% scaling. That would be their decision. Remember, as accountants, we're asking questions. We're not telling them what to do. So that, if you're struggling with this, and I'm certainly willing to help out, but that gives you a quick view of why we're doing this with the LiquiSolvent tool and the kinds of things it's going to result in. Mostly, we're going to find out what we think the abundant cash is for this company and what kind of budget it will support, what kind of sustainable strategy it will support. I hope this helps. Thanks.